The next thing to do now is to forecast the balance sheet. So here you can see what we did, and the truth is forecasting the balance sheet, it can get very, very complicated because oftentimes it's just hard to know what's going to happen to certain things. And let's go through them one by one. So here you can see an overview. This is your asset side, and this is your liabilities and stockholders' equity side. And whereas the income statement, you pretty much start with revenues and you work its way down. This you kind of have to do a little more like a Sudoku puzzle and move around and be flexible and try different things. And it requires a certain level of creativity. So with working capital accounts, we assume that there's some kind of relationship between sales, accounts receivable, inventory, accounts payable, and accrued liabilities. Because all of these things should fluctuate with sales. The more sales you have, the more receivables, because sales is related to receivables in terms of number of days collected of receivables. Inventory is related to sales, really related to cost of goods sold. The cost of goods sold is related to sales. Same thing with accounts payable is related to cost of goods sold, which is related to sales. And accrued liability comes from selling, general, administrative expenses, which also will come from sales. So to keep everything simple, we look at these as a percentage of sales. And you can see this here where we set these up as a percentage of sales. So accounts receivable all these items are set up as a percentage of sales. Current assets held for sale, let's just assume that they sell those. And available for sale investment securities, you can't predict what's going to happen there. So what we do with that is we leave it alone. Current assets held for sale, let's assume that they just sell it because that's something that they plan to sell. You see how you kind of have to improvise these things? Goodwill, let's assume they don't do any acquisitions. And other non-current assets, who knows what that is. You might want to look and see if it's big. And assume that it's changed. Trademarks and other intangibles is going to be amortized because that's what happens to trademarks and other intangibles. So we would want to amortize that. And I'll talk about PP&E and current assets in a few minutes. And the same thing with current liabilities. We have accounts payable and accrued and other liabilities will be presented as a percentage of sales. Likewise, deferred income taxes and other non-current liabilities will be presented as a percentage of sales because income is driven by profit, which in turn is driven by sales. So PP&E would depend on your estimated capital expenditures, and that can be a hard number to get. What you might want to do is look at management's discussion analysis and see if they tell you what their expected capital expenditures are going to be. That's what CapEx stands for, by the way, capital expenditures. And then we want to estimate depreciation expense. If there are any other intangible assets, goodwill doesn't get amortized, but your other intangibles will. So here you can see that we're going to add estimated capital expenditures, and it could just be the same capital expenditures as last year. Or the company may give you some guidance on what they plan to spend on capital expenditures. That's an important piece of information. And 28,656 here is going to be depreciation expense. And usually depreciation expense will be approximately the same as what it was last year. Current and long-term debt, you assume that they make all payments on debt, accrue any interest. Usually current maturities of long-term debt, if their debt is constant, is going to pretty much stay the same. And then long-term debt is going to be reduced. Because what happens is that you pay your current and then something from long-term becomes current, usually the same amount. And So what you can do is, or you can assume that they're not making payments. So I don't know why they assume current and long-term debt remains unchanged. You'd want to read the notes to see why they would do that. So here you can see that um, current liabilities held for sale, I guess they're selling those. Debt due with one year, they're going to pay a portion of that and increase it. They got this from the footnotes. So they saw what the payments need to be, and they took those off. And then they added the new payments that need to be made. I'm not sure, you'd want to read the footnotes carefully and get some guidance on how to do that. Long-term debt is also going down by the amount of money that's being moved into current. That's why that number flows right there. So as debt matures, it first gets moved to current liabilities and then it gets paid. Stockholders' equity paid in capital, unless you know anything to the contrary, will probably stay the same. If they say they plan to purchase Treasury stock or they plan to issue stock, then you're going to need to add that in or subtract it. And then retained earnings follows the formula of beginning retained earnings plus purchases minus dividends equals ending retained earnings. That's the formula that it's going to follow. So minus purchases plus purchases. I'm sorry, I'm confusing the cost of goods sold formula. Beginning inventory plus net income minus dividends equals ending retained earnings. That's the basic retained earnings statement formula. So you can see this, that's how they got this over here. They're taking 87,953. They're adding 10,685. They're subtracting estimated dividends and getting 91,073. Non-controlling interest, they're adding the share of net income that belongs to non-controlling interest. It's just the same as last year. And you get a total liabilities and shareholders' equity. You go back to your balance sheet and you stick that number here. And then, this is the most exciting part, you plug cash. Right there. You plug your cash. And that should give you an idea of how much cash you would have at the end. That seems like a dangerous thing to do. I always thought it is. But when you think about it, cash is what's left. And sometimes you're going to wind up with a really high amount of cash. Sometimes you're going to run up with a low amount of cash. And that would usually indicate that there's a problem. So it seems to me, it always seems to me like a bit of a dangerous thing to do. But in fact, if you have a negative cash balance, that may indicate that there's a problem coming up. Now, with operating assets, what you can do is working capital, again, is going to be in relation to sales. And non-operating could be the same, or they could change in line with what other companies are doing. And this is perhaps another way to do it, another way to look at these numbers. So capital expenditures, your forecasted capital expenditures might be in relation to sales. So if sales are increasing by 1%, then capital expenditures may increase by 1% also. And PP&E assets are operating assets. Likewise with depreciation expense may increase in proportion to the change in PP&E. So if you're anticipating high capital expenditures, then PP&E is going to change, which in turn is going to change depreciation expense. And in fact, that's pretty much going to work, whether you're using straight line or some other accelerated form of depreciation. Ending PP&E would be beginning PP&E plus your capital expenditures minus forecasted depreciation expense. So With intangibles, besides goodwill, you're simply going to amortize them. And usually amortization is going to be the same as last year. If there's a write-off, you may have read in a 10Q or something that the company is writing off some intangibles, then you would also want to write them off. Here in this example, I wouldn't be surprised if amortization expense in 2018 is 326. And as you're going through this, there's a lot of judgment that's involved, and it's really difficult to say that there's a right answer or there's a wrong answer. So in the homework problems, they usually give you enough guidance, so it's fairly determinate that the answer is fixed and doesn't require so much creativity. But in reality, and you'll see this in your restaurant companies, there's a lot of creativity that's required in order to do this successfully. Let's talk a little bit more about long-term debt. What companies do is they report maturities of long-term debt for the next 5 years in their debt footnote. So when you see that, if debt maturities next year are 2760, then 2760 is going to be current portion of long-term debt in 2017 rather. 2760 is expected maturities. 2760 is expected maturities in 2017. Then the current portion of long-term debt in 2016 is going to be 2760. So you know exactly what to put there. So forecasted long-term debt would be the current year's long-term debt minus everything that got moved into current because it's no longer long-term. And retained earnings is, as I said, it's going to follow the formula, or as I attempted to say, beginning retained earnings, I don't like current year, I'd call it beginning retained earnings plus net income minus dividends. And how do you estimate dividends? Is what you might want to assume is that dividends are going to increase at the same rate as income. So if you're forecasting that income is going to increase by 10%, which you did on your income statement, then you would expect that dividends is also going to increase by 10%. Of course, if you have other information, then you can use that other information. You got to read the management's discussion and analysis very carefully in order to do this. So many companies have stock repurchase programs, and so they'll tell you how much stock they expect to buy back as treasury stock. That's the number that you would plug into your forecast, and it would be a subtraction from common stock and paid-in capital. If you don't have guidance like that, look and see what the company has done in the past. And if the company buys a certain amount of treasury stock back every year, oftentimes companies do that in order to pay stock option compensation, then use the same number again going on into the future year.